Hello, my name is Jo Tuffil and I'm an expert tutor for the ACCA. Welcome to this topic explainer video on business and asset valuations. This is a challenging topic for some students and I'm going to go through one particular part of business and asset valuations, and that's valuing debt instruments. I'm going to show you where it links to the syllabus, how it's tested, go through some examples and look at showing you how to approach questions on the practice platform. First of all, here are the syllabus areas for your financial management exam. There are 7 of them. Now, business and asset valuations is syllabus area F. And this is tested only in the MCQ areas of the exam. So you're likely to get some in section A, but more than likely, in fact certain, to get a question on business and asset valuations in section B. What we're trying to find is the market value of the debt instrument, what the investor is willing to pay to obtain that debt instrument from the company. Now, this differs to the nominal value in the financial statements. The market value of the debt will be based on the future cash flows payable to the investor by the company. It's a cash flow based model and we'll be using discounted cash flow basis to value the debt. You need to be able to calculate the market values for 4 different types of debt instruments: preference shares, irredeemable loan notes, redeemable loan notes, and convertible loan notes. Now, the market value of each of the debt instruments equals the present value of the future interest and redemption payments discounted at the debt investor's required return. In order to do this, you need to think differently. When you find the present value of the future cash flows, you're effectively reversing the formulas for calculating the cost of finance when you're doing calculations for the weighted average cost of capital. You're going to be using the investor's required return, and this is the pre-tax cost as it's the value to the investor, not the company. You need to learn the process like a recipe. If you learn the process, the steps to success, you will always get these questions right. Now, the concepts introduced here are also in the study hub, and it's in chapter 18. We're now looking at preference shares as our first debt instrument, and that is in 6.1 of chapter 18. Now, as preference share dividends are a fixed percentage of the share's nominal value, there will be 0 growth of the future cash flow, and the share price becomes the present value of a perpetuity because they're irredeemable. So the ex-div share price is going to be the dividend in dollars divided by the required return from the preference share holder. And remember, that are both pre-tax. There's no tax deduction on that dividend, and the required return is from the investor's point of view. So here is activity 6 from chapter 18, section 6 of the study hub. Here we're looking at a preference share and calculating the market price. So a company has in issue 5% preference shares, each with a dollar nominal value, and the financial press quotes the yield on these shares at 4.7%. So this is how we do this answer. We first of all calculate the annual fixed dividend, and that will be 5% of that nominal value, which is 5 cents, or 0.05 of a dollar. You should always put it into dollars, as cents make no sense. The required return of 4.7% needs to be converted to a decimal, and that's 0.047. And then using the learned formula, D over the required return, you take the 0.05 dividend, divide by the 0.047, and out comes in your calculator 1.06 in dollars. So that's the market price of each preference share. Let's now go on to look at irredeemable loan notes. So we now come on to irredeemable loan notes. Again, this is Chapter 18, Section 6, but now Point 2 in the Study Hub. Now, in the case of irredeemable loan notes, there will be a fixed annual payment of coupon interest this time, into perpetuity, with no repayment of principal. So it's similar to preference shares. And again, we're looking at the ex-interest market price, which will be the coupon interest in dollars divided by the required return on the pre-tax cost of the irredeemable loan notes. Let's now look at an example. So Activity 7, which again is in the Study Hub, says a company has in issue 7% undated loan notes, each with 100 nominal value. The current yield is quoted at 7.42%. Calculate the market price of each loan note. So the formula will be the annual coupon in dollars, which will be 7% of that nominal value of 100, which is $7. That is then divided by that required return as a decimal, and we'll get 94.34 as the market price of each loan note. Just remember the step processes. First of all, find the annual coupon. Then make sure you've got the required return as a decimal and the pre-tax. And then divide the required return into the annual coupon to get the market price. Next, we come on to redeemable loan notes. And this is section 6.3. Now, redeemable loan notes mean exactly that. They are redeemable after a certain period. And so the market value will be the present value of that coupon interest paid each year until maturity and the redemption price paid at maturity, discounted again at the investor's required rate of return. So you can see there's a layout there for you. N is the number of years, and therefore from time 1 to N, interest is paid. And we apply an annuity factor to that to get the present value of the interest, because interest is the same each year. And then the N number of years is when we get the redemption value. Well, that's a one-time value, so therefore we times that by the present value factor. We get the present value of the redemption value, and we add that to the present value of the interest, and we get the sum. And that sum is therefore the market value. So we have an example here to put that technique into practice. The company has in issue 8% loan notes. The 8% is the coupon rate. They're redeemable at 5% premium. That means they're redeemable at 5% above their par value. And the par value is 100. So therefore, 5% on 100 means they'll be redeemable at $105. They have a term of 10 years. And the loan note's yield to maturity, which is the cost of debt, is 10%. So how we calculate this now is we lay out the cash flows and we discount at that 10%. So they're going to get interest at the end of each of those 10 years. So therefore, we're going to be getting interest from time 1 to time 10. And we'll be getting interest at 8% on the par value, which is 100. So 8% times 100 means we'll be getting $8 interest per annum. The redemption value comes in at year 10. And I've already said that is 105 because it's 100 times by 1.05 because it's 5% premium, which is 105. We now need to discount those cash flows. The interest is payable every year for 10 years, so that's an annuity factor. And it'll be an annuity factor for 10 years at 10%. we need to go to the discount tables to find that annuity factor. So here we have the annuity table, and we need 10% for 10 years. So that equates to 6.145. 6.145. We now need to find the present value factor for the redemption value, because that comes in year 10, at the end of year 10. And again, that will be at 10% for year 10. So here we have the present value table, and again we take 10% for year 10, and the value is 0.386. So 0.386. We now simply times the cash flow by the discount factors. So we'd be timesing the 8 by the 6.145, and then the 105 by the 0.386. So that gives 49.16 and 40.53. You now simply total those up to get the market price of the loan note, which is 89.69. So again, learn this as a stepped process. The final debt instrument that we come to are convertible loan notes, and this is section 6.4. To estimate the value of convertible debt, it's first necessary to predict whether the investor will choose redemption value or conversion. The redemption value will be known with certainty, of course, because that's the cash value. But the future share price can only be estimated. So two values can be calculated for convertible debt: a floor value and a market value. Now, often the market value will be based on the conversion value, because often the share price will increase with time and outstrip the cash price for those loan notes redemption. So here we have a formula for that conversion value. It's the current share price times by a growth rate over the term of the loan note times by the number of shares that you get on conversion per loan note. We now follow the same process as for redeemable debt, and we calculate the present value of the coupon interest and the higher of redemption price or conversion value discounted at the investor's required return. So the market value can be the same as the floor value if you choose redemption, which is higher than conversion. We're now going to look at another example, and this also comes from the Study Hub. So here we have a practice example calculating the market price of convertible loan notes. The scenario here has a company that has in issue 9% loan notes. The 9% is the coupon rate, and they're redeemable at their nominal value of 100. Now remember, the coupon rate of 9% also works off that nominal value. They have a term of 5 years, and these are now convertible. Each bond may be converted in 5 years' time into 20 ordinary shares. Now we have some information now about the current share price and its expected growth rate. So the current share price is $4.45, and it's expected to grow at an annual rate of 6.5%. We are now told that debt investors' required return is 7% per year. 7% will be our discount rate, therefore. We're now expected to complete the following tables to find the floor value and the market value. Now, the floor value and the market value might be the same. It depends on whether the convertible loan note holders would convert or not. So the floor value is always based on the redemption value. Here, that would be the $100. But the market value will depend on whether you're going to receive the higher of the conversion value, which would be based on converting them, or the redemption value, whichever one is highest. You need to calculate the conversion value first. And in order to do that, you've been given the formula. So the conversion value is the current share price compounded up for the growth rate over the number of years to maturity, times by the number of shares you get on conversion. So in this example, the growth rate is 6.5%, but as a decimal, that is 0.065. The number of years to conversion is 5, so n equals 5. And the number of shares that you'll get on conversion per loan note is 20. So the conversion value will be the current share price of 4.45 times by 1 plus the growth rate, which would be 1.065, compounded up for 5 years, times by the number of shares, which is 20. So you put that into your calculator and see what you come out with as a conversion value. Once you've found that value, you're able to decide what is therefore going to be used in the conversion value calculation down here. Is it going to be the conversion or redemption value? Remember, the floor value, we always use the redemption value, but for the market value, we need to pick the higher of conversion or redemption. So you decide. Once you have those figures, then you're simply going to times those cash flows by the discount rates already given to get the present values, and then total them up. Good luck. Why not practice this yourself and then check your answers in the next slide. So here is the answer to that activity. It's actually activity 9 in the study hub. So the market value is now going to be based on the conversion value. And the forecast conversion value is 122. That's because the share price is forecast to be 610, and you times that by the 20 ordinary shares that they will receive. Now, if you compare that to the redemption value of 100, conversion will be preferred. So therefore, the market value of the convertible loan note is 123.89. The floor value, therefore, is based on redemption of 100, and that will be 108.20. Hopefully you got those correct. Congratulations if you did. We're now going to go onto the practice platform and have a look at a question there. We're now on the practice platform, and this is practice exam 2, and it's a case study question, Coral Company. And so you're going to be looking at question 22, which is on asset valuations. Here we have to find the conversion value and then the market value of each loan note, assuming conversion. So there's our share price, $7.10. It's a 7% convertible loan, and it's redeemable after 6 years. And it can be converted into 10 ordinary shares. And we need to see that it's going to grow by 8%. So all the figures were in different areas, which is why it was difficult. And then we have this before tax cost of debt to discount at. So I've summarised all that in my scratch pad. I'm now ready to calculate my conversion value, which is 10 shares times by 7.1 times by 1.08, which is the growth rate, to the 6 years. So it's 112.67. Now I need my present value factors and my annuity factors from my tables. So 6 years at 5% is 5.076 for my annuity factor. And for my present value factor, 5% and 6 years is 0.746. So I'm timesing that conversion value by the 0.746. And then I'm going to add the $7 interest timesing by the annuity factor of 5.076. So the answer is 119.58. Excellent, my answer is there. So that's the end of my topic explainer on debt instruments. Remember, it's a stepped process, like a recipe. You need to learn how to do all 4 of those debt instruments. I wish you every luck in your exam. Thank you for listening.